Time. Let's continue this market conversation with Fundstrat Global Advisors co-founder and CNBC contributor Tom Lee. Tom, it's great to have you on. You're constructive on stocks right now. The fact that we do see the VIX hitting that 20 level, the fact that we have seen stocks trading lower and back at the beginning of the summer levels as well. Do you see this as a time to buy? And if so, why and what?
Well, there is going to be a time to buy between now and year end. I mean, you're describing it perfectly. We're in a period where fear is mounting. I mean, the VIX is capturing that. Investors are afraid to be in front of the freight train of higher rates. But at the same time, we know that the PMIs have bottomed. There's a ton of cash on the sidelines. You know, earnings are recovering, and the Fed is that much closer to sort of reaching the end of its tightening cycle. So to me, it's a formula that when the selling ends, and I wouldn't be able to tell you if we're at that turning point, but that recovery in markets could be very violent, higher, in the sense that the PE compression that we're seeing, I think, is excessive, and the pessimism is excessive. I mean, the economy actually is holding up really well. So I think investors should just remember the best opportunities to really make money have all come during periods of fear, whether that was March 2023 or it was October 2022. So yes, I think it still makes sense to be constructive, but it does feel terrible out there.
It sounds like, if I'm reading between the lines correctly here, that while rates could go higher, yields could go higher here, at least in the near term, that you don't believe, Tom, that they're going to stay at these levels. I mean, Morgan Stanley's Michael Wilson saying again, and I realize he's a consummate bear, but basically saying that the correlation between real rates and equity returns has fallen deeper into negative territory. I mean, if you're valuing equities off of the bond market right now, how much opportunity is there actually? Well,
I mean, here's some simple math. You know, the long-term average of the 10-year is, I don't know, it's probably around 4.8. I mean, we're probably right there. So someone buys 10-year and says, I'll earn 4.8 or 5% forever. Well, the average S&P nominal return is 8%, and actually after a drawdown like this, it's probably 10% a year. So someone could invest their money today in the S&P and earn double the return over the next decade, or they can earn half of that owning a treasury bond. I mean, I know if someone thinks 5% is competitive with equities, it's not even competitive with the long-term return of stock. So I don't know where yields are going to go. I don't think we're going to be a juggernaut higher. But if they're flat here at 4.8, since 1932, whenever you're at 4.8%, the average S&P PE is close to 19.5 times. I mean, there'd be multiple expansion coming, you know, in that range of yields. But if yields fall, then I think multiples go up. Of course, the TLT is a huge buy, but that would bring mortgage rates down. It would be a pretty big stimulus to the economy. So I think the only risk is if rates go to 7. I don't know if they're going to go to 7, but that is not what I expect.